Upon finishing this video, you should have a very good understanding of the following questions. Read through them quietly to yourself. As you are taking notes, make sure to pause this video in order to answer these questions. Here is some important vocabulary that you may want to pause the video in order to write down. When you are finished, go ahead and resume. So what is a pip? A pip is nothing more than a unit of measurement that expresses the change in the value of the market. In other words, in the same way that you express time in minutes or in days or in hours, we're expressing the change in the market in pips. If it goes up, it went up a certain amount of pips. If it goes down, it goes down a certain number of pips. It is nothing more than the fourth decimal number after the comma. You see in this picture here, the 13021. And by the way, that's not supposed to be a comma, it's actually a period. So that's really 1.3021. The 1 is the pip position. Now you know what a pip is. How do you actually calculate them? Remember, the pip is the fourth digit. So here's an example. Here's a scenario. You enter NZD/USD at 4.56567 and exit at 4.56772. How many pips did you gain or lose? And first of all, pay attention. Notice which numbers are the pips position. Okay, make sure you pay attention to that, because what you're going to want to do is you're going to want to subtract these numbers, but you have to know which one is the pip, which one is the one that has your focus. Now you know what a pip is. How do you actually calculate them? Remember, the pip is the fourth digit. So here's an example. Here's a scenario. You enter NZD/USD at 4.56567 and exit at 4.56772. How many pips did you gain or lose? And first of all, pay attention. Notice which numbers are the pips position. Okay, make sure you pay attention to that, because what you're going to want to do is you're going to want to subtract these numbers, but you have to know which one is the pip, which one is the one that has your focus. Now what you're going to do is you're going to take the 4.56772 and subtract it from 4.56567, and you're going to get, it's going to equal 0.00205. Now let me just stop and pause you. You know what? Some people can get all up in frenzy about which one do you take first to subtract. If you want, go with the bigger number. If you end up with a negative number, who cares? Ignore the negative. So really you can just punch these in any direction. The most important part is that you get that answer equals 0.00205. Now, one way that you can find out how many pips was in this situation is you take them, subtract them, and then you can divide by 0.0001. Is going to equal 20.5 pips. Why did you want to divide by 0.0001? Because remember, the pip is the fourth decimal place after, or the fourth digit after the decimal place. So if you divide by that decimal, you're going to get 20.5. Now, if dividing numbers gives you the EBGBs, there's a whole other way that you can solve this. There's an alternative way, and this is the way that I personally like to use, because I don't like dividing numbers either. I'm not a dividing type of person. If you move the decimal over 4 places to the right, remember, the reason why we're moving it 4 places to the right is because the pip is the fourth digit to the right of the decimal. So if you take that point where it says equals 0.00205 and you slide that thing over 4 places, you will get the same answer. So here's what it looks like in, written out for you, for those of you who are visual people. See how I took the decimal and I slid it 1, 2, 3, 4. Equals 20.5 pips. Super easy, super easy. We're going to do another example, don't worry. Before I go ahead and do another example, I did have to mention the pipette. Some brokers offer prices that are up to 5 decimal figures after the comma, and it's much more accurate, so they say. Really, what I say is it really just gets in your way, makes you mad, and you thought that you were calculating pips, but you really got confused with the 5th digit. So know that that number is the pipette. So in this picture, you see 1.3020. That 1 is the pipette. Let me tell you now, ignore that number. When you're calculating, don't even add it to your calculator. Or if you do, act like it's that invisible friend that you had. Or act like, I don't know how many of you guys had siblings. I had siblings. What I would do is I would pretend they were invisible. It used to make them really mad. I know I'm not the only one who did that. But that's what you do with the pipette. Act like it doesn't exist. The one that you care about is the 4th decimal place. So now here's our second example. You enter New Zealand dollar at 1.098992 and exit at 1.16971. How many pips? So right now, you should have your calculator out. You can pause the video. You should be subtracting these numbers to find out what that decimal answer is. All right, now after doing that calculation, you should have entered the 1.09892 minus the 1.16971, and you should have gotten 0.07079. All right? Now, notice that these are color correlated, the colors are correlating to different things. The blue color is correlating to the pip, and the 1 is the pipette. And remember, what are we supposed to do with the pipette? Ignore it. So after finding out what the actual decimal number is, this method is for people who like dividing. If you're the dividing type, then what you want to do is you want to take that 0.07079 and you want to divide it by 0.0001. All right? The reason why we're dividing it by 0.0001 is because, remember, the 4th digit from the decimal is the pip. That is why we're dividing that by 0.001. So when you take 0.07079 divided by 0.0001, you should get 707.9 pips. All right? That's for you guys that like to divide stuff. That's not usually my style. And now for my favorite style, like I said, I'm not down with that whole dividing thing. I'm kind of more of a decimal sliding type of girl. What you do is after you subtract those numbers and you get the decimal number, all you got to do is just move the decimal place over to the right. 4 places over to the right. It's just that simple. Here is an example. So take 0.07079 and then you just slide the decimal place over 4 times. See that? 1, 2, 3, 4, and then you get 707.9. Isn't that so much easier? I mean, I like it. Anyhow, why do I like it so much? Because I can now just mentally do the decimal sliding without having to bring out the calculator and all that. So when I look at my phone, I can easily just mentally slide decimals over. But for those of you who like to, bust out the calculator and do some division, gets your juices going in the morning, now you have 2 ways of doing it. You can either do the calculator version or you can do the mental decimal slide over version. All right, either one's up to you, and they work both very well. Now let's actually put it in action, because most of us aren't going to be looking at numbers like this. We're going to be looking at the chart. Why am I having you calculate pips like this? Because when you start analyzing charts, you're going to want to start calculating where is your take profit going to be? Where is your stop loss going to be? Now, of course, there are fancy tools like on MetaTrader 4 or TradingView, but to get you started, this is how it works. So let's say you enter, and I already have the entry price at 1.09207, and you exit at where the blue is at 1.08962. What do? You get it. You are going to subtract those numbers. It's going to equal 0.00245. You can slide the decimal over 4 places to the right, and then you end up with 24.5 pips. Hopefully, this is getting more simple. If not, please replay this video. There are some exceptions to the rules, such as yen pairs and gold pairs. In yen and gold pairs, the second decimal figures after the pip is, after the comma is the pip. So, for instance, look down here. It says, if USD JPY rose from 103.25 to 103.26, that deviation was 1 pip. Notice there's not 4 decimal places. There's not 4 digits after the decimal. This only applies to yen and gold pairs. Here's a really awesome picture that you can snapshot for your notes. Take a screenshot of it, take a picture of it, write it down until you get it. Notice how on one side you see 1.25418 and it shows you the pipette. And then on the right, remember what I told you to do with those pipettes? We ignore them. So you don't see an 8. You don't see a 3. Okay? So the top one is for pretty much every other pair. The bottom number, the 1.273, represents yen and gold pairs. So why not? Let's just calculate what it's like. So you enter ABC XYZ at 95.343. I didn't realize all this rhymed. And exit at 95.445. How many pips did you gain or lose? So hopefully you kind of understand the gist of it. You take 95.343 minus 95.445 equals 0.102. Now, notice how you divided by 0.01. Why did you do that? You did it because there are 2 placeholders after the decimal. Remember, on yen and gold pairs, the pip is the second digit after the decimal. So that's why you would divide by 0.01. That's one way of doing it. Now, the other way of doing it, you already know, is slide the decimal place 2 spaces to the right. Remember, 2 places because the pip is the second digit to the right of the decimal in yen and gold pairs. Okay, so now you have a yen pair right here, and you can see that, remember, this one's a little bit different because you have 2 decimal places. What you're going to do is you enter that 111.443 and you exited at 111.909, and you should have gotten 0.466. See, after sliding the decimal places 2 places to the right, you should have ended up with 46.6 pips. Is it now starting to make more sense to you? All right, now I want you to try. Practice. How many pips did you get? If you entered, notice at the bottom, your entry is at the bottom at 144.549, and you exit at 136.06. How much did you gain? And here's another question. Was this a buy or a sell? Well, why would you get in for this? Would you get in for a buy or would you be getting in for a sell? So 2 questions. How many pips? And would you be getting in for a buy or a sell? All right. So hopefully you've done the math. If you did the math, you should have got something like this, 8.489 in your calculator. So now if you slide the decimal over 2 places, that's 848.9 pips. Woo-wee. And by the way, this would have been a very good buy order. You wouldn't have gotten something like this unless you were doing like a long-term order. By now, you should have a good understanding of the following questions. Read them quietly to yourself, and when you are finished, go on to the next video in this series. Thank you so much. My name is Adeze Duncan, and remember, I am a student, always. You should have a very good understanding of the following questions. Read through them quietly to yourself. As you are taking notes, make sure to pause this video in order to answer these questions. Before we go into the lesson, I want to actually talk about some very relevant vocabulary. So please make sure you take some good notes on these vocabulary words. Now let's recall what a pip is before we actually get to talking about leverage. Remember, a pip is the change in price and an exchange rate. Remember that movements occur to the 4th decimal place out. So these are very small movements. I'm going to talk about this more shortly. Let's also recall how you profit. Remember, you're buying and holding. So you're capitalizing on the difference in exchange rates. You buy an exchange rate at a certain price, and then you turn around and sell it at a different price. These exchange rates change in the form of pips. That's how we measure it, similar to how we measure time in minutes. In order to make some money, you're going to have to purchase a large amount of units of currency. Remember, guys, you're purchasing rates, units of currency in the form of pips. So you'd have to purchase a large amount of currency. So I have an example here. Let's say you bought the Euro USD at 1.10895, and then you decide to cash out at 1.10973.
Now that's actually a difference of 7 pips. So think about it. If you only came to the market and you were able to buy up enough to make 7 pips off the market, you would have made 0.00078 cents, which is pretty much nothing. So you would have to come to the market with quite a large amount of money. Looking at that difference of 7 pips, how much money would you actually have to come to the market with in order for it to be worth something? So let's say you invested $1 into the Forex market. On $1 and you gained 7 pips, $1, okay, you would get 0.00078 cents. Really nothing. If you invest $10 of your own money into the market, now you're at 0.000, oh wait, hold on a second, I'm looking. You get it, 0.078 cents, okay? And then what if you come with $100? All right, finally you're in the race. You've just made almost 8 cents in the market. If you invest 100 of your dollars, you just had a return of about 8 cents. If you invest $1,000 of your own money on 7 pips that you've gained, now you have just made 78 cents. Whoop-de-doo, right? $10,000. Now you've made $7.80. If you come to the market with $100,000, now you've made $78. That's really not a very good return on investment. You understand that now. Now you see why, in order to get into the Forex market long before internet and all these online brokers, you would have had to come to the table with a lot of money. Most investors did not come with anything less than 100,000. That's even laughable. Nothing less than 500,000. You would have had to invest some serious money, ongoing money, to be able to reap those good returns. One thing I want you to notice is where you actually started to make money. Notice you actually started making money at around $1,000, $10,000, $100,000. There actually is a name for those numbers, for those higher numbers. So now this brings me to lots. This is one of those vocab terms. What is a lot? A lot is referring to a contract being made of a certain size, aka those sizes that I was just talking about. You purchase them in bundles of units called lots, and they're standardized contract sizes, okay? So it's no different than if you wanted to buy, say I have this picture of water. If you wanted to buy some water, a 32 pack, and you go to the store, you can't just say, I want to just buy one of those water bottles out of 32. You have to buy the whole bundle. So now what your online brokers have done is they've gotten together and they've created standardized contract sizes in the form of lots. So these are the lot sizes that I was talking about. These are standardized contract sizes. So you have a standard lot, which is 100,000 units, a mini lot, which is 10,000 units, a micro lot, which is 1,000 units, and a nano lot, which is 100 units, okay? So remember when I showed you that screen, you didn't really start actually making any money off of 7 pips until you got to around $1,000. So that's why people now buy them. Like instead of saying, I want 10, let me just get 10 lots, let me get a little small 10 piece. You're not going to do that anymore. Not in the Forex market. It takes money to make money. Looking at this screen, you can see how lot sizes can correlate to the profits and losses. So a lot of people get very excited about standard lots, because at $100,000, you're now able to make around $10 per pip. At a mini lot, you're able to make about $1 per pip. At a micro lot, you're able to make about 10 cents per pip. And at a nano lot, you're able to make about 1 cent per pip. Most standard size accounts will only let you trade between a standard lot and a micro lot. You would have to get a special account in order to trade nano lots. Those are pretty much trade pennies. You're actually making pennies off of a pip versus 10 cents per pip. Something else I wanted to point out was that column that says volume. Instead of going to your MetaTrader 4, you're not going to see 100,000 units. You're going to see something that says volume, or it might not even say volume. It's just going to show decimals. Those decimals stands for volume. If you put 1.0, you are now purchasing a standard lot. If you do 0.10, you're purchasing a mini lot. If you do 0.01, you're purchasing a micro lot, and you get it, so on and so forth, okay? So make sure you have that right. 1.0 does not mean you're going to be making $1 per pip. That means you are purchasing a standard lot. So you want to make sure you're very attentive to that area. That is the number one area where people lose a lot of money, because they either, one, enter things the wrong way, or they don't fully understand the importance of risk management, which we will teach you going forward. This is what it looks like on a computer for those of you who like to trade off of the computer. What I was talking about with volume, that 1.0 right there, that means that person is trading using a standard lot. You can change it. It doesn't just have to be 1.0. It can be 2.0, which now means you're getting $20 per pip. It can be 5.0, which means you're getting $50 per pip. Here's what it looks like on a phone, and I really just included only one. So you've got, this is an iPhone, but it looks very similar on an Android. It doesn't actually say volume, it's more of just a decimal. So in this situation, this person is trading with 0.05, which means they're going to be making 50 cents per pip. Okay, does that make sense? If they had 0.08, that means they're making 80 cents per pip. So they're basically trading with a micro lot, or with 5 micro lots. If you're trading with 10 standard lots, then that means you're going to be making $100 per pip. If you're trading with 10 micro lots, well, that's pretty much your now you're trading with a mini lot. So anyhow, you get it. So now that we know what types of contracts are which, let's go back to our scenario where you made 7 pips out of the market, okay? When you look here, remember, on a standard account, you cannot trade anything less than $1,000. Why? Because you're going to be making pennies, and then after that, you're not going to be making really anything. So that's why there's only these standard contracts, such as micro, mini, and standard. And remember, on a micro account, a micro contract, you can make 10 cents per pip. So in this situation, it makes sense that you made 78 cents. All right, because it goes by tens. You take your 7 pips and you multiply it by 10. On a mini contract, you can make dollars per pip, $1. So in the event that you happen to go up 7 pips, that makes sense that you made $7.80. Now remember, on a standard account or standard lot, you can make $10 per pip. So it makes sense that when you've made 7 pips out of the market, if you take 7 times 10, you've now made $78 per pip. Now the real question you might be sitting here scratching your head and asking is, so do I really need to bring $100,000 or more to start trading? Well, yeah, duh, of course you do. Just kidding. You make sure you always read the fine print. No, you do not need to bring $100,000 or more. And there is one main reason, one superpower in the online market. And that superpower is referred to as leverage. Oh, sorry, that's my amazing music. Sparkle, sparkle. It's leverage. Leverage is what allows you to bring whatever money that you can bring together to the market to be able to trade with the big boys. Let's talk about this leverage. When you sign up with your broker, you are asked to select a certain leverage amount. You might have been told to select a 1 to 100 or 1 to 200. It goes all the way up to a 1 to 4,000. So you've selected something, most likely not knowing why you selected those. What exactly is leverage? Before I even go all the way into that, it's a strategy that allows you to use borrowed money, borrowed capital, to increase your potential returns. So you use leverage in the market, you use leverage when you're buying a house, you use leverage in real estate, you use leverage when you invest, period. It just makes more sense. You saw in the description, in the illustrations earlier, you could bring $100,000 and still only make $78. That's not exciting. That's not fun. Who wants that kind of return on investment? That's what you get from your banks, pretty much. In leverage, in order to be able to take part in leveraging, you would have to have a deposit. So you would have to come with some money. But your money is going to be more like a down payment than anything. Instead of having to come to the table with $100,000, now you can come to the table with a certain amount of money in order to be able to use that money to leverage more money. Now back to what I was talking about as far as, when you selected that leverage when you first got into your broker. So for instance, let's say you selected a 1 to 200 leverage. That actually means that for every $1 in your account, your broker is going to let you leverage $200. So let's say you deposit $1,000. Now you have the ability to use up to $200,000. It's pretty awesome. So here's another example, another leverage example. So let's say you selected the 1 to 100 leverage. That means if you deposit $1,000, you now have access to up to $100,000. Remember, for every $1 you deposit, your broker will allow you to use 100. If you selected the 1 to 4,000 leverage, which is crazy, that would mean if you deposited $1,000, you would have access to up to $4 million. Sounds really tempting, doesn't it? Something I want to point out to you though, remember when you selected your whatever leverage you selected, that's that leverage. So let's say you selected a 1 to 200 leverage. That would be considered your maximum leverage, meaning that is the most you can take out. That's like if you go to buy a house and you give them, $50,000, they loan you $300,000. It's not very wise to use all $300,000. It's not necessarily the best idea to do that. You want to give yourself some room to move around, to breathe. Especially if you're trying to renovate the house, you want to give yourself room to, for renovation expenses and whatnot. Your true leverage is what you actually use at any given time. So let's say you're approved to use up to $300,000, but you go and buy a house that's about $100,000. Now you still have a lot of room to move around, all right? It's not wise to use the max amount of leverage in any one trade. You can use all of the money, but as long as you diversify it, that's what you want to do. You want to be able to diversify. So never use 100% of your account in any one trade. Very bad idea. And here we go again with a review on our original situation. Remember, when you made 7 pips out of the market, if you want to really come to the market with $100,000, go for it. Make that $78. Woohoo! Yay. Or not. See, with leverage, now your ROI percent can increase without having to deposit that much money. In other words, if you come to the market with somebody else's money, you have the ability to grow your account significantly. Much more than you would coming with your own money. Some people really like, ooh, I don't want any debt. But honestly, it works really good when it comes to investing. It takes money to make money. Yay for OPP. So what do I mean by ROI? Return on investment, for those of you who don't know what I'm talking about. Let's say, remember, you deposit $100,000 of your own money, big baller, and make 7 pips. Your ROI percent would be 0.07%. Wah, wah, wah. Not really exciting. Now, if you deposit $1,000 of your own money and make 7 pips using a 1 to 100 leverage, which allows you to trade up to $100,000, your ROI would now jump to 7%. Much better. Look at that. You deposited less money and still come out with a better ROI percent. It only makes sense, and that's why leverage is amazing. I already said it earlier, but I will say it again. Leverage can be awesome, but leverage can hurt just as bad without proper money management. By now, you should have a good understanding of the following questions. Read them quietly to yourself, and when you are finished, go on to the next video. Here is some important vocabulary that you may want to pause the video in order to write down. When you are finished, go ahead and resume. Upon finishing this video, you should have a very good understanding of the following questions. Read through them quietly to yourself. As you are taking notes, make sure to pause this video in order to answer these questions. So first, let's review what is a buy and what is a sell. Remember, a buy is when price value rises. So you want to be getting in at the lowest price. You want to buy low and sell high. See, and then sells are when price value should be getting ready to fall. So you see here in the picture, I have examples of where would be the good place to get in, at the bottom for the buy and at the top for the sell. And as long as you stick with your education, you will eventually start to feel more comfortable guesstimating where those locations are. The first type of trend I want to talk about is an uptrend. First of all, how do you even know when the market is trending? When the market is trending, it's going up or down. There is also a sideways motion that's not necessarily called trending. It's called consolidation, which I'll talk about later. So what makes up an uptrend? An uptrend has higher highs and higher lows. So if you look in this picture, you can see that one high was higher than the last high, which was higher than the last high, and you get it. And then one low is higher than the last low, which is higher than the last low. So how would you want to trade on an uptrend? You would want to look for long-term buys and short-term sells. What do I mean when I say long-term buys? That means obviously this trend is overall going upward. So your best bet is to get into good buying positions. That means it's going up for the long run, but occasionally there are downward retracements where the market goes down. That's what the retracement is. Or the market goes the opposite direction for a short period of time. That is a retracement. It's one thing to see a really pretty picture. It's another to actually see it in action in the market. So here's an illustration of what a good uptrend would look like. Constantly making higher highs and higher lows. Now the next one is the downtrend. The downtrend is just like the uptrend, except it's going down. It's making lower highs and lower lows. You can see one high is lower than the last high, which is lower than the last high. You get the idea. So what you want to be looking for is long-term sells and short-term buys. Why? Because the retracement, and remember what I said, the retracement is when the trend goes the opposite direction of the overall for a short period of time. So obviously this thing is overall going down. When the market goes up, that would be considered a retracement, and you're making lower lows and lower highs. So short-term buys, meaning it's only going to go up for a short period of time, but overall it's going down. So you want to be looking for longer-term sells. It's very important to understand what type of trends you have. What is the market actually trending? That's going to be in your best bet. We'll talk about it shortly. Again, here's what it looks like, not in a pretty picture, but actually in the market. These are very simple to spot, and it's best to look for a trend on the higher time frames. I'll say that again. It is best to find the trends on a higher time frame. That way you have a good idea of what you're looking at, because it can look like one thing up close on the small time frame, like the hour. But when it can look like it's going up on the hour, but if you go and look on the day chart, you'll see that this is actually a big downtrend, and it will help you know, are you in the long-term sell or are you in the short-term buy? You need to know where you're positioned at. Next, you have what is called a ranging market. This is not trending. So you see how the market is moving sideways. It's just going up and down, but it's not really going upward in any kind of direction with any kind of momentum, or downward with any kind of direction and any kind of momentum. There are other words for this. The market is moving sideways. It's called consolidation. It's also known as indecision. Make sure you pay attention to those three things I just said, because you'll hear these terms used and eventually you yourself will start speaking those terms. There is no actual higher highs, no lower lows being made. This is the worst market to try to trade off of. Unless you know, like if you're using like the higher time frame, then obviously you can get some major pips. But if you're using a smaller time frame, like the 4 hour and below, it is not advisable to trade ranging markets unless you decide to specify and specialize in ranging markets. I would say not a good idea to trade during consolidation. You'll just be on an emotional roller coaster. You'll look at your phone and see that you're in profit, and then you'll come back and see that you're negative, and then you'll come back and see that you're in profit, and you will just feel some kind of way. So best to stay out of consolidation. So what is consolidation? If you want my definition, what I have is, it's that nasty, disgusting crap that does nothing but hurts your feelings and confuses you, also taking your money. That's what I call it. Why? Just out of experience. Another name for it is indecision. Like, the major players of the market haven't made a decision in which direction that they want to take the market. So as a result, it's at a standstill. Some people are placing buys, some are placing sells. As a result, they cancel each other out, and you have the sideways movement. So here's a good example of what consolidation looks like in the market. There's a nice major area of ranging or consolidation or indecision, all of those different names. Here's another picture. You see some on major scales, and then here's some on like the smaller scale. This is the hour chart. You can tell in the background because it says 60 seconds, or it says 60, which stands for 60 minutes, not seconds, sorry. These consolidation patterns can tell you a lot of different things. The stronger and longer the consolidation, typically the more powerful the movement in either direction. Your job is to get on the right side of the direction. As I stated earlier, I'll state it again. It is best to get out of these areas. If you are trading and you decide to enter into this area, be prepared to lose a lot of money. Be prepared to think that you were in a buy and now it looks like it's a sell, and then you decide to try to sell and then it turns out to be a buy, and then you're just losing money all along the way. It is best to stay out of choppy markets. Stay out of the market. You may have heard the statement, the trend is your friend, and there is a reason for that. Here's an example. For instance, do you see this downtrend? You see the higher highs, all those different higher highs? If you would have got in at any given time, let's say you got in at the very top, if the market went up, if it retraced up like it did, remember it's making higher highs, or excuse me, lower highs. Notice how it's making lower highs? Let's say you got in where that arrow is pointing. As the market made its move downward and then retraced up, you're not out any money. Why? Because it's not going to outdo it because it's on a downtrend. So anywhere you get in on those retracement areas, also known as pullbacks, would be a good area for you to get in. That's why trending markets are the best markets to trade, because it cuts your risk level. It cuts your risk of getting stopped out down. By now, you should have a good understanding of the following questions. Read them quietly to yourself. In this video, you should have a very good understanding of the following questions. Read through them quietly to yourself. As you are taking notes, make sure to pause this video in order to answer these questions. So let's get started on what a candlestick is. In this picture, you see an example of a candlestick. These are called Japanese candlesticks, or you usually find them on the OHLC chart. I'll talk about that shortly. So this candlestick is made up of a big fat region called the body, and then the little skinny things coming out of it is called the wick, also known as the exhaustion or the shadow. It's good to follow these because they tell you a lot. I'm going to go into what each of these mean on the next slide. So I mentioned an OHLC chart, okay? What that actually stands for is open, high, low, close. So if you look over at this picture, you have the top of the wick, the very tippy top where you see the arrows pointing to highest. That means that this was the highest that this candle has reached. And then the L for low stands for lowest, which means this is the furthest down that this candle's reached. And when I'm talking about the highest up and the furthest down, do you see the body region? That body, the big fat portion? That means at one point, the body of the candle was all the way down to that tippy top or the very bottom. So now, because the body could not stay down there, what you now have is the close and the open. So the open stands for where did the candle first begin? Where did it actually open up? What was its opening price? And the close was, what was its closing price? This is important when you start talking about different time frames, because different candlesticks take a certain amount of time to form. Some can form in 5 minutes, some can form in 1 week. Depending on the chart you're looking at is going to determine when it actually closed. But this OHLC will tell you the actual open, high, low, and close prices in the market. Now, a little bit more about these wicks. They actually tell you a lot about decisions being made in the background. Sometimes you'll see really, really long wicks like you see in A, or sometimes you won't see hardly any wicks at all like you see in candlestick B. Wicks actually give you signs that the market is wanting to move in a certain direction. For instance, when you have long wicks forming in certain areas, it is a sign that the market, and when I say the market, I'm talking about all those candlesticks on your chart right now. You see all those candlesticks that are forming. Some of them are going up, like overall they're going up.
and some of them overall are going down. But what I'm saying is, when you see wicks in certain areas, it's telling you that the market may not want to move much higher, may not want to go up higher. So what you find is you find a long wick. Now, what do we know about wicks? We know that wicks tell you the highest that the market had reached at a certain time. So when you see long wicks forming, that shows you that the market tried to move into that area, but had a hard time staying in that area, right? So that is a good sign that there could be a possible reversal or a possible turnaround. If you look in the picture, you'll see where there are wicks. You see in that little purple region right there where there's lots of wicks in that area, and then all of a sudden the market turned around and went down. That's an example of what I'm talking about. So pay attention to those wicks. They tell you a lot. They tell you that the market may not be trying to move in that direction. Wicks are also like what we call fake outs, meaning that the market was moving up in that direction, but it decided not to move in that direction. And we call it fake outs because it faked you out. You thought it was moving up, but it actually was not. Or you thought it was moving down, but it actually was not. So here's another example of wicks. You see I have wicks drawn all over the place, but just take a look at this picture and look at where you see wicks, especially in those certain areas, those purple regions. Notice how you see those wicks and how the market actually did turn around. Eventually it made a complete turn. You see, at the very bottom where the arrow is pointing downwards, how the market reversed and moved upwards. It's just important to pay attention to those wicks. Pay very close attention to them. They are a good sign that the market may want to turn around. Not a end-all be-all, but one of the indications, one confirmation that you can use when you are making a decision about what you think the market is going to do. Notice I said a confirmation. When you guys make decisions, you need multiple confirmations, and having wicks as one of them can be a good confirmation to add to your tools. By now, you should have a good understanding of the following questions. Read them quietly to yourself, and when you are finished, go on. On finishing this video, you should have a very good understanding of the following questions. Read through them quietly to yourself. As you are taking notes, make sure to pause this video in order to answer these questions. Before we talk about what support and resistance is, let's review. Remember, we talked about Japanese candlesticks. And if you don't remember, go back and watch the video titled Price Action, which was one that was before this one. Okay, so let's just review real quick. Remember, you have a Japanese candlestick. That's what this little structure is on the screen. The little skinny, pointy, prickly looking thing, that is called a wick, also known as a shadow or exhaustion. And then you've got the body of the candle. All right, so those wicks, remember, we talked in price action, they tell us a lot of information. They tell us a lot of information of what the market is indicating. Is it trying to go in a certain direction? It gives you a lot of information about which direction it's looking at going. Okay, you remember that we talked about the OHLC chart. That's something that you want to make sure you recall. So if you do not remember, please go back and watch the video titled Price Action. Now let's talk about resistance. All right, resistance is one of the first things that we'll talk about. Resistance is like a ceiling. So if you see in this picture, you see how that wick was approaching the line, but it was not trying to go above the line. See, resistance is kind of like a ceiling where price struggles to get above it. So you see in this picture, here's another really good example, a lifelike picture of resistance. You see how all of those wicks, or how even price action came up to that area, that line, and had a hard time going through it. So when I say struggle, I mean that, price was on its way up there. Price makes moves up or down or sideways, but in this situation, price is making its move upwards, and then it stalls. So that stalling point is what causes people to draw resistance lines. See, resistance is not like some specific or some special, magic line that everybody knows exactly where it is. Most people are all looking in similar places. So your resistance line, let's say I draw it where you see it right here on the screen, and maybe you drew it like a hair above that, and maybe somebody else on the other side of the globe
drew it a hair below. Nonetheless, we all see how price is struggling in that region. And so that is why we draw a resistance line there. That resistance line is showing, it's just a symbol that this is an area where price is seemingly struggling. Okay, does that make sense? Now, much like resistance, you have support. Support is like resistance, except it's like a floor, or it is a support. So in the same way you stand on the ground or on the floor and the floor holds you up, price is held up in this area. So no, obviously it's not literal. Price does not actually hold, or excuse me, the line is not actually holding price up, but you can see how price made its way down to that area, and you see how the wick is touching that line or near that line. That line is more of a region than it is an actual hardcore line, all right? But support is like a floor. It holds price up. So here again is another picture of the actual market with an actual support line. So remember what I was talking about with resistance. That line is not a magical line that, you know, everybody all across the world has the same line in the same area. It is just a guesstimation of where I see price has been turning around. You see price has been turning around. She and he sees price turning around. So it's more of like a guesstimation than anything. It's a region where price has come down and gone up. Now, the reason why you want to draw these kinds of lines is because you're creating a map. You're basically mapping out what price is doing. All right, so you can see how price came down the line, came down to the line at one time, and then it turned around and went up. Then it came down to the line again, and then what happened? It turned around and went up. So now you see price approaching that same area. All right, what are you going to be thinking that price is possibly going to be doing? Probably turning around and going back up. Now, we have no crystal balls. Nobody gets to say what's really going to happen, but what you do get to do is start to create a map of what you think price is going to do. So as of right now, because it's above the line, we're looking for the possibility that price will come down to it again and turn around. So in this picture right here, you also can see that it says support can become resistance and resistance can become support. So what does that mean? Well, really, support is only support if price is, you know, above it and is bouncing off the top of it, meaning if price has come down to it and has found support, meaning it hasn't broken below. Resistance is only resistance if price is below that line area, so price is going upward, approaching that line, but not going over it, okay? So the only reason why a line is support or resistance, it really just depends on where price is actually located at that given time. So now you can see how that same area, that same region that we called support can become resistance. You see how it's been touched multiple times? You've got support here and you've got resistance over there. The more touches, the stronger the line. So what do I actually mean? So what do I actually mean when I say the stronger the line? I'm going to give you an example of what I mean when I say the stronger the line. Okay, when my husband and I decided to buy some furniture, I bought a table, or we bought a table. I picked it out. I love the table. He didn't like the table. We got it home. You know, we put it in the kitchen, and I loved it when I saw it. So my husband thought it didn't work there. It was too big. It just took over the area. I said, I love it. It's great. Just believe me. And he still was like, no, I don't like it. So here we go. A friend comes over and they said, oh my gosh, I love the table. It's amazing. Oh, I just love it. He's like, you really think so? You really like that table? I don't really know. Here we go. Another friend comes over another day. Oh my gosh. Oh, this table that you got is so perfect. It just fits the area well. And he still looks at the table. Yeah, I mean, it's okay, I guess. I don't know. I really don't know about it. Third person comes over. Oh my gosh, the table. I love the table. You know, and this is him, my husband. Yes, you know, I thought the table looked really good. We were actually thinking about getting chairs and putting them over here. Now, all of a sudden, my husband likes the table and is actually acting as though he picked it out and has plans to put new chairs and whatnot by the table. So what do I mean when I say the more touches, the stronger the line? In the same way that my husband needed at least 3 other people to come by and reassure him that the table is amazing. Now, all of a sudden, he loves the table. In the same way, the more times price touches the line, the more we as traders think that this is an area where price is going to react. I hope that makes sense. Something else you want to keep in mind in regards to support and resistance zones. I want you to know that they're not like this perfect little line that you draw where, you know, price has to come and touch this perfect little line. They're more like zones or broad areas. So you know, the reason why I have them drawn as zones or broad areas is because not everybody is going to be looking at the exact same place, but they're all going to be looking around the same area. So when you think about price and it having a reaction, you know, maybe you drew the line about 5 pips below somebody else on the other side of the globe, but everybody across the globe all sees the same area. So when you draw them, make sure you draw them more like areas. If you put a line there, know that price can react anywhere near, below, or slightly, you know, or above that area that you drew, okay? So now let's talk about how do you actually draw support and resistance. I talked about what they are. Now let's actually get into how would you actually apply and draw them. And guys, after you watch this video, I want you to go to TradingView or MetaTrader 4, and I want you to actually practice looking for what I'm about to talk about next. Start practicing drawing these immediately. So now, looking at this actual frame, you see here how price goes up and then it turns around, or, you know, price is going down and it turns around. I like to call these major reversal areas. Nothing, you know, rocket science, nothing amazing. You can see that it was an area where price reversed majorly. It wasn't like, you know, I'm just kind of you know, slightly chill and, you know, do a little dip and then keep going up. It was a complete U-turn, complete turn. So those areas I call major reversal areas. It is definitely, it comes down to how you see them. What do you determine a major reversal area? It doesn't have to be perfect. It just has to be a major reversal area. So when you see one of those areas where price came and did a major turn, that could be an area of support and resistance. Remember, a support line is resistance. It depends on what side price is on. Okay, so looking here at the picture, you see where I drew those lines? Most likely, you would have drawn those lines similar in those same situations. The problem is you don't actually have to draw like 50,000 lines. You want to always start where price is currently at and draw your lines starting there. That's where you would want to do it. And if you want to actually have, you know, more interaction and see how I draw them, or even be able to ask questions, please come to my channel on Forex 101, where I talk about drawing these lines regularly. So this is just, you know, obviously you can only see it in the still frame, but I want you to actually practice this. Look for where you see major reversal areas. Now look at this one. You see how in this one, there is no lines, there's nothing going on this slide. Okay, if I just showed you the slide and I said, hey, so what do you think price is gonna be doing? Where do you think price is heading? Especially people who don't know anything about, you know, marking up their charts, probably assuming people who are on this, you know, actual video right now. If I showed you an empty slide with nothing and I said, okay, so tell me where price is heading. It's going to be very hard. Maybe you can say it's going down. Maybe you don't realize it's actually on its way up. Maybe you don't realize that. But when you actually put the lines in, then it becomes more clear. Now, here's that exact same picture, but with the support and resistance areas drawn. Now, when you look at it, maybe you guys are noticing that, okay, price was going down, but now it's reaching that area of support. And I'm thinking, if price gets to this area, I think it's going to turn around. So I'm going to be looking for a buy. Now, here's the really cool thing, guys. I looked at this exact same frame. This frame was taken, you know, about, I'd say, from the time of this recording, this frame was taken about about 2 weeks ago. I took this picture about 2 weeks ago from the time of this recording. At that time, I was saying, you know, I did a presentation and I said, look, if price gets to this area, then I'm going to be looking for a buy. Now, if you go ahead and log onto your computer and you look at the same exact area, you will see that price did in fact come down to that area and turn around and go all the way back up. It did exactly what it did in the past.
So it's worth drawing these lines to show or to create a map. Does this happen every single time? No, but what you're doing is you're creating a higher probability trade. Every time you trade, you're not going to win. But what you want to do is you want to increase the probability of you winning. And you can do that by drawing these lines and creating these nice if-then statements. You can see in this slide, again, I talk about if-then. If price is here, then I will be watching for this area. So you see how it says I'm watching this area? That actually means I am looking specifically at this area to see what did price do in the past. And as you see where that other area, where that other arrow is pointed, you see how price came down and turned around. Just as I said in the last slide, I talked about how price did exactly what it did in the past. You want to be looking for what price has done in the past to get an idea of what it could do in the future. Okay. Also, you also keep in mind that if price is above that area, then you want to be more partial to be looking for buys. If price is below, then you want to be more partial for looking for sales. By now, you should have a good understanding of the following questions. Have a very good understanding of the following questions. Read through them quietly to yourself. As you are taking notes, make sure to pause this video in order to answer these questions. I want to make sure that you guys have already seen the video, What is a Trend? Very important for you to know what a trend is before you look at this, because hopefully by now you can look at this and clearly see that this is a downtrend, or let's just say it's trending downwards as of right now, according to this time frame. Is it a overall established trend line, or trend going down? We don't know, but right now in this exact picture, it does look like it is overall going down. We learned in What is a Trend? That the trend is your friend. Why is it your friend? I'm going to explain to you using pullbacks why trends are your friend. Why is it a good idea to only get into markets that are trending versus the ones that are ranging or consolidating? This is why, for these pullbacks, okay? So a lot of times people are always looking for entries. All right, they want to know, what's the best entry? Where do I need to get in? What's the entry? Where do I get in? Here's the thing. Remember, none of us have a crystal ball. Most of us will never catch the very start, the very top of a trend. All right, so do you see in region A, that would be like considered the very top of this downtrend. Most people will never catch that. And most people will think they missed the move. A lot of people who are experienced might catch it, but most of us may not catch it. Okay, so then does that mean that, oh shoot, I missed the move, I didn't get in, it really sucks, No, there's another place called a pullback. So you see how in region A, it fell, and then it pulled back up to where region B is, all right? That pull back upward is called a pullback. Also could be called a retracement. That's, the more technical term for it, but that would be considered the pullback, okay? So you can actually get in there, and a lot of times when price makes its move, it goes down in an impulse and it has to go up in a nice little correction upward, kind of like it's taking its breath. That would be the time for you to get in, all right? If you miss that, then you can get in region C. See where it says C? That's another place for you to get in. See how price fell down and then it pulled upward again, and and then it fell some more. All right. Now, why are those areas good? Think about it. If you got in region A and the market pulled up, are you going to be in bad shape? No. Why? Because the market never retraced 100%, or it never retraced all the way back, eclipsing your original position. All right. If you got in region C, would that be bad for you if the market retraced upwards? No. Why? Because it never retraced all the way back up to region B, eclipsing anything. All right. So then, let's say if you got in on region D, you still would be in good shape, because most likely your stop loss would not be, it would be up higher. So it never would have actually, eclipsed your original entry. Now, let's say you accidentally get stopped out. Okay, no use crying over spilled milk. jump in on region D and ride that wave down. So now you see all the black arrows, those show the best entries of when you should get in. The white ones show the worst entries. Let me go ahead and play this out for you. Think about people you know. Somebody calls a signal, they say, get in now, and then what? An hour later, you got all the people, is it still time? Can I still get in? Is it still a good time? Did I miss it? Is it still good? Okay, those people are trying to jump in around those white arrow regions, kind of in the middle. That's not a good time to get in. The market's not pulling back. It's actually in the process of moving downwards. That is not the time that you want to get into the market. You're getting caught in the middle, and you don't really know what price is going to do. But when price is trending downwards, when it's going down and making lower lows and lower highs, you know that, okay, this is just a pullback. I'm going to go ahead and jump in on this pullback, and I'm going to wait for it to fall. All right. That is why trends are your friend. You don't get to do this in a ranging market. In a ranging market, you don't know if it's going to go up or down or go completely down or go completely up. You don't know that. But in a market that is trending down, you know that it's heading downwards. So it's okay if it goes up for a little bit. You know it's just a short-term upward movement before it goes down some more. Pullbacks are the best time to get in. And a lot of times in a downtrending market or an uptrending market, you're going to get plenty of pullback opportunities to jump in. All right, stay out of the middle. If they called a trade an hour ago, most likely it's too late. Wait for it to show an upward, or downward. Wait for the pullback. Wait to see signs that it's ready to go, and then jump in. By now, you should have a good understanding of the following questions. Read them quietly to yourself, and when you are finished, go on to the next.